So we continue on with our commercial loan training program, and this is regarding advanced commercial loan deal locating. We'll show you how to actually go out and have a meaningful conversation with a commercial lending client, and also how to find new opportunities for these sorts. As we like to say, there's 16 ways to fail and 2 ways to succeed in the commercial business. It's not easy. It's definitely different than what you've experienced in the residential world or some other sales aspects. But this is what translates to the opportunity. There's very few people that have taken the time to actually be good at this. There's a lot of myths and challenges to the commercial loan business, but most of these are created by the people that are out there marketing these loans. And one of the big myths out there is loan to value and rate. The number one question, and really the first question we get into our call center, is what's the highest loan to value I can get, and what is the lowest rate that I can get? This is absolutely, totally, completely the very largest deal killer that there is out there for commercial loans. In theory, as the slide says, we could offer 100% loans, but in practice they don't exist. We even offer 90% loans, and later on you'll see some charts and graphs that show you what percentage of these loans are in our pipeline. They're very, very small, and the big issue is that the debt service coverage ratio is a very rigid underwriting test, and if a property will only cash flow to 10% loan to value, then telling you that a 90% or an 80% loan to value is the maximum is really a disservice. So, as an observation, we could tell you that loan officers are found to be frequently shopping against themselves. They run out into the marketplace asking for the highest loan to value and the lowest rate possible. They quote the client, and then when the documentation is received by an underwriter, the deal is dead because we can't reach those expectations. So, commercial loans are usually transacted as such. First, there's a sales process that's completed by the loan officer where, again, possibly what's the maximum loan dollars I can get and what's the cheapest rate that you can get for me. An investor is chosen, an appraisal is ordered by the investor, and when that appraisal comes back, it'll come back with value, net operating income, debt service coverage ratio, and some defined approaches that the appraiser will work out in terms of cap rate and marketing time and some other technical issues. So what happens if any of those factors comes in and it falls out of bound with a single investor program? Well, your loan might be dead, and this is the issue with going out into the marketplace. The value proposition, in other words, what the client is trying to accomplish or what the motivations of the client are, need to be very well understood right at the beginning so that a laser focus can be placed towards acquiring the correct investment. So in this slide, you can see that transaction coordinator consolidation is not an easy subject. So when an investor is chosen, preliminary term sheet goes out and the appraisal is ordered and the appraisal is completed. Question, what happens when the value? Well, in our world, in a loan consolidation world, the world reopens and the file is re-underwritten to a new funding strategy. If you go to a single bank, you go to, and I won't throw names out, but you go to any of the big players, and if once all these reports are completed, the loan does not meet the expectations of that lender, you're out the appraisal money, you're out the environmental money, and so forth. One thing you can rest assured on is that the deal will change once the appraisal is completed. Most everything that was on the initial term sheet, the letter of interest, will change once the value and cash flow is known. Here's what we know about getting the right attention for your transaction is that absolutely no fantasies allowed. You need to get the right documentation at the start, and again, one of the prevailing issues that our company has with these commercial loans is that the documentation will come in, for instance, missing 1 year of tax returns. Well, that forces an underwriter to guess. So using the correct approach and not embellishing in terms of how great the borrower is, how great the property is, how great it shows from the street, that sort of thing. You're far better off saying, I have a multifamily property at 123 Main Street, here's a photo of it, and here's the initial documentation. Let the underwriter decide what the true attributes of the file are. Set the right expectation that 4 to 6 weeks is considered fast. There are some 3 and 4 week loans rumored to be out there somewhere in the world, but we have not ever seen one go down that quickly. Appraisals are expensive. If you have a refinance transaction, the borrower can easily remember what he paid for the other one. But appraisals will go anywhere from $1,500 up to $10,000 and more, depending upon the type of property. The thing that you should caution every borrower on, and the thing you should set expectations for, is that, again, as we've said before, the change is absolute once the appraisal and the due diligence is complete. Be prepared for change. It is what it is, and we'll just solve for the challenges that we're given. So you can think of transaction opportunities out there as full documentation, light documentation, which just is very, very similar to stated income loans. There are alleged to be some no-doc loans that have come back into the marketplace. We haven't seen them out there, and they probably have something to do with the straw borrower, which is not legal. So obviously our firm doesn't offer these, and I suggest you don't either. Hard money, private money, is what it says. It's very expensive money meant to solve a very short-term issue. Construction and rehab money is definitely available for nice projects in major metropolitan areas. Major metropolitan, we mean 100,000 or more people within 25 miles or so. Completion loans go right on up there with construction and rehab loans. And again, these are loans, completion loans I'm speaking towards. These are loans that you may encounter where somebody's begun construction or begun conversion of a project, ran out of money, bank closed, funding source dried up, something like that. Junior liens are very, very rare, and they are generally prohibited by senior lien holders, meaning that somebody holding a first mortgage probably has language in their contract that says you can't have a second mortgage. Some exceptions to this would be SBA money, but again, this is very important that you check. Full documentation loans are what you might think of coming from a bank, and banks will generally only lend on conforming building types with conforming borrowers. What that means, translated, is they want nice buildings with good borrowers, with good credit, with good experience, with good cash reserves. You know, like they used to say in the old days, is that if you don't need the money, we'll lend it to you. The neat thing is these loans will generally have lower rates. The cash out will be extraordinarily limited. So if you have a borrower that says, I need $1 million cash out on my multifamily property, those are generally very difficult to place with Main Street banks. Everything must be documented, and every document is required and not waived. Most of these loans are very widely misunderstood. They're rigid, and quite frankly will force people right out of the business because they're so terrible to get completed. Stated income loans are back in the marketplace. They sound simple, but they may not be. There's a lot of misconceptions out there that the loans will fund faster, appraisals are required, appraisals are not required, environmental insurance is not required, credit's not checked, and so on. The reality of this is that the loans are perfect for off-color properties and borrowers, with the big issue being, or the big caveat being, that they need to be in major metropolitan areas. One of the things that has really hurt these investors during the last recession was that a lot of loans were done in rural communities, and those buildings are probably still sitting empty. The rate can be depended upon to be higher than fully documented loans. There's more risk, hence the rate will be higher. Hard money loans are very, very close and cousins to the stated income loan. They have their place, however they are misunderstood. They have high rates, high origination fees. In other words, I come to a hard money lender and say, I've got this terrible situation that I'm in, I've got this marginal building, but I need you to lend me $1 million on this transaction. Well, You can find that sort of money. Generally, the investor will be in that local area and they need to be paid to compensate for the risk. Cash out is not going to, or will be severely limited or not allowed. These loans are to get people out of balloon note situations, or to get people out of tax lien situations, divorce settlements, any number of things, but something fairly diabolical. So, commercial loans, there's 5 to 7 items that we'll talk about here next. So you should collect those 5 to 7 items, submit the loan, and let your chosen underwriting staff determine what the best outcome might be for the borrower. Unfortunately, 5 to 6 out of 10 of the loan transactions that you will encounter don't have a home. You could waste 50 to 60% of your time, or you could take the simple way out and, Mr. Borrower, give me these 5 to 7 items, submit it, and get an answer back. Before we do that, we'll talk a little bit about appraisals and closing costs. The key component to the transaction are appraisals. Appraisals are paid out of pocket by the borrower. And these appraisals will greatly depend upon property tier, meaning classification. Multifamily would be the easiest, down to a gas station might be one of the toughest. The appraisal is absolutely the highest risk to the transaction. This is where the debt service and the net operating income and those sorts of things are absolutely determined. Closing costs on a commercial closing statement will show some very foreign items. There will be such things as environmental database reports. There could be an environmental insurance policy, due diligence services such as property inspections. There might be phase 1 and phase 2 reports, and most of all, title insurance can be very expensive for commercial transactions. So if you get a commercial client, the entire reason why we're covering this here, don't attempt to give the borrower a truth in lending statement or a preliminary closing statement, because you'll be wrong. Our company actually issues something called an RE 882 at the time we issue a term sheet, and that will go to the borrower and we'll do the hard work for you. But the appraisal is absolutely key to the process. This is the greatest failure rate in any commercial loan. Prepayment penalties and lockout penalties, two different animals. Prepayment penalties are a fact of life in the commercial world. Nobody wants a prepayment penalty from the borrower perspective, but from a lender perspective, they're obviously desirable. Some investors will raise discount points and not charge a prepayment penalty. This is mainly in the hard money arena, but all the client's doing is just paying the prepayment in advance. You could buy down prepayment penalties many times, but the major consideration is if you have a borrower who says, I don't want a prepayment penalty, I would just keep walking. Lockout penalties or interest guarantees are applied to ensure loan durability, meaning that if we put a lockout, which by the way, I don't think these are present in the marketplace today, but they very well could come back here pretty soon. The last thing an investor wants is a churn. In other words, when they make a loan, they want the loan to stick and they don't want it to quickly be replaced by another loan, because their yields will decrease. But a lockout penalty will be something to the effect of, if any time during the first 5 years you pay off the loan, you owe me 5% of all the interest that would be collected. So you think about it, a 5-year prepayment penalty could equate to 25% of the loan amount in a penalty. Lockouts and prepayment penalties are bundled together frequently. But again, I want to be real clear that nothing in our product offering has a lockout penalty today, but the other thing is considered is the ability to repay. If a borrower says, I'm flat broken, and they give you a personal financial statement or a loan application and there's no cash reserves, there's no income, the ability to repay is severely compromised. You'll want to spend some time to come up with a plan on how they're going to repay. Loan to value is not the same thing as debt service. So loan to value will ensure that there is an equity cushion. And commercial properties will require a far greater equity cushion for this reason. If you hear that somebody will make a 60% loan-to-value loan on a commercial property and you say, hey, wait a minute, in the residential business we're getting 90%, 80, 85%. There's many people that would stand in line to buy a residential property. There aren't very many people that would stand in line to buy a 4-unit retail center. So these properties take substantially more revenue and expenses to move in a secondary market during a foreclosure. So hence there will be more equity cushion. Bad bet properties, you could read through this slide, but one of the key factors is in a commercial real estate loan, you must have real estate. Don't confuse business loans with commercial real estate loan. Business loans are reputed to be made by the SBA. However, the banks down in the trenches will require that you have real estate behind it. FF&E is not a qualified asset, furniture, fixtures, and equipment. So if you have a borrower that has 25 washing machines and a coin laundromat, that is not a qualified asset. The building is. So you could say that, do you do this type of building? Do you do that type of building? If the building is not on this list, you should be fine. There's plenty of takeouts for these buildings in the marketplace. There are dedicated commercial loan processing systems out there. Our technology division created this for another company. It's called Snap. And this takes care of client management. In other words, it's sort of what you would do with Outlook, Calendar, or what you might do with any other contact relationship marketing. And in addition, all the information seamlessly flows to a pricing screen. In this particular scenario, it's difficult to see, but with the preliminary information entered in, the SNAP system, we market this under 4 other different names. However, it would compute loan programs that are available for that borrower. And if you had this system in shop, which I don't recommend you do initially, if you start building some volume and have many leads, then I would definitely recommend that you look into getting something like this. But from an approach, you want to have dedicated commercial loan systems. So as we get into this, you're going to want to deal with commercial loan, commercial client sorts of lead sources, email source, telemarketing sources. Don't confuse the two. You can't make a residential telemarketer into a commercial telemarketer. You cannot make a residential or an insurance email marketing company into a commercial loan company. We'll show you and give you examples of persons you can contact to get. As you're going through and you're collecting client profiles, there's one to make you aware of what actually funds in the back end. Although we have programs that go all the way down to what you see C credit there, it only represents, this is about a year old now, 13% of our funded pipeline versus 43% or almost half are A+ client credit profiles. And if you look at everything in between, although there are plenty of products out there in the marketplace, in fact half of all loans that are being made are made in the A+ credit grade. So if you have a client that has horrible, terrible credit with bankruptcies and tax liens, are there products for them? Yes, there are. But will they actually fund? Well, it's a 50-50 scenario, whether or not they'll fund. If all you get are C credit and B credit borrowers, you're going to get very frustrated, because only 17 or 18 out of 100 will come to a funding. That's horrible. So the loan validity check, we call it LVC, is anticipating issues. On refinance loans, do you have the 5 C's and 1 M? Purchase transaction, do you have the 4 C's? We'll show you these in just a minute. But if you're missing any one of these items, then you're going to have an issue with your loan right from the get-go. Missing more than one, you need to question the transaction. If a borrower can't come up or prove this particular aspect of a loan transaction, you'll likely have an issue closing the loan. Here's an observation that came up during the preparation of these slides, is that rural loans with outer fringe properties, poor credit performance. In other words, if you have a gas station in a town of 3,000 people, and it's a really nice gas station, but it's still rural, and those rural businesses will very frequently have seasonal cash flow translating into poor credit performance. You are not going to get very far with these. So here's the 5 C's and 1 M of loans, and you can pause this video if you need to write these down. But credit, meaning credit report; collateral, meaning the type of property. Remember back to where we had the properties, the bad bet properties? Well, you're going to want to make certain that you've got a property that'll work in the greater expanse of things. Capability to repay is debt service ratio. You're not going to be able to compute this coming out of the gate. However, you can collect the documentation and let the chosen underwriter of whoever you send this loan to come up with that. Compensating factors, this would be characteristics of the loan, meaning Uncle Bob will sign on to the loan and help correct a cash flow or credit issue, or it's an exceptionally nice multifamily property in the heart of New York that just happens to have a borrower of poor credit. That would be a compensating factor. The submittal form that you could use ours, or you can type up an executive summary, but remember this is a letter to the underwriters. Make it in plain English, use correct punctuation, don't use all capitals, things like that, because underwriters in any environment will have seen a lot of these in a given day, and you'll get the most attention if it's easy to read. If there's a cash out component, what's the motivation? Both these go hand in hand, meaning that if a borrower has no particular issues that would cause them to refinance, in other words, if they tell you, I just want to see what rates are, you don't need to put a lot of work into that. If you just want to see what rates are, tune up CNN.com. You can research these on the web. We actually have a rate sheet. Most investors will have a rate sheet. You can pull any rate off of there, and I can assure you that that rate will have nothing to do with what the loan will fund at, because there's all these other factors. So you could pick a 3% rate off an investor's rate sheet, but if something is at issue with the credit, or if something is at issue with the debt service ratio, all of that was for naught, and the borrower has the wrong equity. In a purchase transaction, what you're really looking for is collateral, capability, credit, just like we talked about in the previous slide, but the big thing is cash for the down payment. The cash is going to have to be declared. It's going to have to be above board. It can't be hidden in the mattress. We need to see, any investor needs to see, any underwriter needs to see where the cash for the down payment is coming from. There has to be equity in the transaction. The closer you get to 100%, the less likely your loan will be fundable. Rate sheets, as we've talked about, and everybody has these, but rate sheets are by their nature deceptive in the commercial world. There's so many factors that go into even determining if a property will meet the qualifications of a particular investor. No deal is complete until the appraisal is complete, meaning that if the debt service decreases, or the loan to value increases, or the value of a property goes up and down, I can tell you that nearly every final approval is given off the base rate structure using internal compensating factors, manual credit, manual debt service. It's not an easy subject, but the point being is these rate sheets will not do you service. In the SNAP, our loan processing software, again, you can see down the bottom here, there's 2, 4, 6, 7 programs that came up in this theoretical scenario. It gave rates, it gave programs, it gave fees, it gave yield spread that might be available, so on. This made it very, very simple for this particular individual to come up with all the programs for this particular transaction. Back to environmental protection methods. We talked about this lightly, but in any commercial transaction, an environmental report or an environmental insurance will be conducted. And when we use the word insurance, this is not for the benefit of the borrower, and we'll frequently hear that, well, I already have property insurance. This is not the same. Environmental protection says there's nothing there that the state, the county, the city, the federal government will take issue with in terms of inflows from other property, a tanker truck that dropped a load of gas, a gas station with leaking tanks, a dry cleaner that had some questionable disposal services. All of this is cleared. However, each loan product, each investor, each bank will have a different method of clearing it. So this is something you'll want to ask at the onset to the borrower if they know of any environmental issues. If you use our submittal form, it's incorporated into our submittal form. So environmental will be completed before the appraisal is ordered. We need to ensure that compliance can be assured. And this is kind of a funny subject in that we receive these 80, 90, 120, 150 page reports, and all we're really looking for is the conclusion. Either further work is required or no further work is required. But there's strict liability on lenders if there is an environmental issue, so I can assure you that the environmental engineers take great effort to make certain that there's no possibility of an environmental issue. This is just a slide that blows up of the type of information that's needed on a property. So if you look in the upper right hand corner, this is our environmental section where we need to document all of these sorts of issues that would affect an environmental report. We do this at the get-go so that we can look and see if we'll have an issue. It's very common that if there is an environmental issue, we'll go back into the history books and look and see what the previous environmental reports might have contained. There is lien and value, and by liens we're talking first liens, which is first mortgage, second mortgage, and tax liens. If you notice, we have three other lines there for tax liens. Tax liens could be income tax, payroll tax, property tax, environmental tax. There can be any number of taxes on a commercial property. On certain properties, once you submit your file into underwriting at any investor, you may promptly receive an environmental questionnaire back for the borrower to complete. This is really dependent upon the type of property. Gas stations will obviously receive far more diligence than a set of 50 brand new apartment buildings. How to submit meaningful loans that are really fun. I can't tell you folks that probably 90% of the people that attempt commercial loans stop within 2 or 3 submissions because they get so frustrated. This is really important that you understand how to submit meaningful loans that are really fun. That takes a decent property, it takes a motivated borrower, and above all, it takes benefit to the loan. Why is the loan needed? If there's no benefit, there's likely no loan. If there's not a balloon payment, there's no cash required, we don't have something going on that would motivate the borrower to invest themselves in a refinance transaction, I can't see that there will ever be a loan. And I could tell you that we look at hundreds of loan submissions a month, and when there is no motivation, the borrower doesn't go beyond just a letter of interest, what's your best program? It's a shopping expedition. And this will be very, very, very frustrating to you. But the reason for needing cash will guide you in overcoming objections throughout the sales process. You've got to understand this basic principle. Cash needs to be required by means of savings and monthly payments so they can increase their cash flow or to pay off any of these things. If there's a balloon payment due, meaning that the loan has timed out and it needs to be paid off, seemingly depending on the borrower's situation, that should be a very motivating condition. However, if you don't correctly identify the balloon payment and the motivation behind the borrower and their feelings and their idea of how important this is to them, you won't get a loan. During the submission process, it's not about rate. It's just not about rate. Basics are always the same. And in order to submit a refinance loan, we ask for an executive summary or a loan submission form, and this goes for any investor. Photos, digital photos, not scanned photos, not black and white photos. Digital photos are really important because, as we've talked about, the property goes a long way towards determining whether or not we have a viable loan or not. A 1003, which is a residential loan application, is generally accepted, or a PFS. This would be an SBA, personal financial statement form. If you need those, we could send you one. Otherwise, they're available online. A tri-merge credit report on each client. Tri-merge credit report is not the same as a free credit report. FICO scores are not the same as the credit score that's available on those free credit reports. You need a tri-merge credit report. If you have issues or situation with acquiring those or getting tougher and tougher to get for the 1- and 2-man shops, let us know, let your investor know, and we'll see how we could help. Last month's mortgage statement is very important so we can see the true balance, the true payment, And generally, we look for things such as late charges. If there's late charges, we know there's an issue with the mortgage, and it doesn't mean the loan's dead, but we can correctly set the conditions well up front. For purchases only, an executed purchase agreement and a rent roll if a multi-tenant property. This would be for apartments, this would be for retail centers that have multiple tenants. And this is a valid statistic. 76% of all first submissions are so incomplete that we can't make a finding. And this really gets frustrating for the borrower, for the loan officer, for internal folks, the underwriters, and any organization where you get some of the file and, with a question, give me your best rate, please. It just doesn't work. So I could tell you that these documents that you're submitting, get it out of your head that these will not be the only documents required to fund a loan. These packages are big. However, your job is to get the submission package and to present the term sheet to the client. In our company, you're done. Our processors will take over and acquire the remainder of the documents. In others, such as the banks, that may or may not be a true statement. You may still be required to go out and chase down documents. However, in ours, we just want the basic documents. In the world of commercial loans, there are 4 different means of getting a product from the submission process. In other words, once you've submitted the initial documents, you can get a quote back, which these are just terrible. There's no underwriting that's taken place, and by default, anybody receiving a quote is just going to get some random lowest possible number off of a rate sheet, and that's what's going to get tossed out to the client. So we hear it all the time that a Class D property with a C grade, D grade credit profile has a quote of 4%. It means nothing to us, and the poor client is just lost. You could get a letter of interest, which is very unique in the commercial world, that we have interest in proceeding further, but again, there's minimal underwriting that's actually occurred. If you look back at the submission documents that were required, that's just not enough to get a commercial loan done. In a commercial loan, by the time you get down to funding in a conventional product, you could easily have 100 documents in the file. In a stated income or some of the smaller loans, you'll still have 35 to 40 documents in there. I don't recommend you pick up the processing on these. Whoever you find to be your investor, hopefully they'll handle the processing for you. A preliminary term sheet will be underwritten with existing facts. Cash flow will be looked at, value will be looked at, any number of things will be looked at. So this is well up on the food chain of possibilities for your submission product and what you can return to the borrower. Final term sheets, we get asked for these, and in the community we have a lot of borrowers that want a final term sheet. They want a commitment after they've submitted those minimal documents, but I can assure you that the final term sheet, the final commitment, is issued after all of the documents are in and all of the third parties are completed. This has appraisal, but it's all the third parties. That would be title, environmental. So many times, and I just want to dwell on the term sheet process, you can generally get these back in 4 to 6 hours depending upon workload if you have a correct set of documentations. The term sheet will be issued. You, as the originator, will get the term sheet back to call it out to your client or to have the client sign the term sheet. Processing in any environment will issue what's called STIPs, and these are additional documents that are needed, such as signed tax returns and any number of things, schedule of business debt, so on. So use your tools, don't call your processor. In our environment, these come out in a very automated fashion. In any environment, you'll get a list of documents that are required by underwriting, by the processors, by the appraisal. And I could tell you that people in that arena, the underwriters and processors I'm speaking about, absolutely hate it when the next phone call comes and there seems to be an argument over what an originator or what a borrower believes should be supplied. Just get what's asked for and don't engage the customer in transactional events. Meaning that talk to the client about, we've got this term sheet, here's the documents that we need. Don't engage the customer in saying, I don't know, I don't understand, I just don't believe that they really need that. Just get it. You need to maintain a proactive condition. Appreciation rate, we're speaking back to values now. During the term sheet or even the letter of interest process, we're looking for appreciation rates. We're looking for values of property. If you purchase property in 2000, the year 2000, for $100,000, and a few years later the current stated value is $1 million, you can see that that is not going to be very likely. So later on we have webinars actually, and on our Facebook page we have actual website services that you could use to comp out properties and get accurate property reports so that we're all on the same page regarding values. Talking about single tenant owner occupied buildings, these buildings are very hard to classify. This would be, for instance, a laundromat. This could be a daycare center. These are all single tenant. There's only one tenant and they're owner users, and they are among the hardest to finance. When you get a term sheet back on these, you'll find that the terms are not very favorable. However, there are loan products available for them, but these are terrible products to go out, or terrible types of buildings to go out and investors. Environmentally sensitive properties are tough. There's a high likelihood that these will not be funded. In today's environment, due to the increasing diligence by the government, these are becoming less attractive to investors. So gas stations, dry cleaners, anything that, for instance, heavy industrial where there's manufacturing occurring, just stay away from it. We've included a little bit about marketing and production best practices here, business operations, and this is really important. If you're going to go out into the commercial world, as mentioned, you will find that you can very easily get frustrated. What we'll talk about here is a means of avoiding some of that frustration. You want to target small business owners, target commercial property owners, and direct appeal works best. Residential style mass marketing where you're hanging flyers on cars and billboards and these sorts of things don't work. We've seen people come, we've seen people go, we've had our affiliates try this, we've seen other investors, other lenders, brokers try this. It just does not work. This is a niche product. You need to go directly to the people that have these buildings and these pieces of real estate and talk to them directly. It's important that you spend a little time getting to know about the product. We've spoken to the types of buildings that you should market to and the types of credit grades you should market to, and we've spoken to the fact that it's darn near suicidal to speak to rate and loan to value until you know more about what the borrower is trying to accomplish. If you encounter a borrower, again, that has no benefit, no motivation, I would not spend a lot of time on it. So fortunately or unfortunately out there in the marketplace, there's something called a co-broker transaction. We have other videos on this, but it's where one broker might bring you a transaction, or where you in turn might take this to another broker who is minimally informed. I could tell you that we've done some very deep research into this, and those represent about a 7% closing ratio, meaning that if you did 100 of these, you're likely to close 7% of them. Because you think about it, you have a client that's talking to their broker, who's talking to you, who's talking to the investor. That's 4 parties involved. It just does not happen. Take that in contrast to a direct transaction where you're speaking directly to a borrower and you've got about an 80% closing ratio if you know your product. If you see deals come in off the street, or in our case, if we tell you that they've been heavily shopped, I would not spend a lot of time on them. Or if you are going to spend time, find out where they've been, what's gone wrong, how come the borrower hasn't made a loan decision yet. Our marketing department can help you with marketing, and we also have a video called Commercial Loan Marketing Secrets. We post these on our YouTube and Facebook channels, and we'll actually give you the names and phone numbers and web addresses of services you can use to go out and get. I can tell you that most of the deals that we fund by our submitters seem to be just off a sheer chance. Hence, that's why you'll find that very few submitters will ever do more than 2 or 3 loans a year, versus the power producers that'll do 4 or 5 loans a month each. So if you add that up, that's 45 to 60 loans a year. Well, these are the people that have become experts. And direct appeal actually works the best with business cards, referrals, direct to borrower. We've spoken to a few things here, but I highly recommend that you consult our Facebook and our other videos on acquiring this data yourself. I would no longer use title company data, but that's just us. So sales channels, we talked about co-brokering. These are all the reasons why, as spoken to before, that we don't think they would be good. Real estate agents are great, but it's imperative that you control the sale of the loan product. I mean, you don't want a real estate agent handling both. Loan brokers are great. However, you're going to find that almost every loan broker out there is residentially based, and they are just minimally educated. They haven't taken a lot of interest. So you'll need to take control. However, one of the key factors is, like we've mentioned here on the bottom, that you want to talk directly to the client. Bankers, you'll find, are very conservative, but they are a tremendous referral source. If you can make great banker relationships, they are. So the 7 myths, and these are things we've talked about, but rate is not driven by desire, meaning that debt service, loan to value, prepayment, interest guarantee, property type, credit, all of these things will drive the rate, not desire. It's not what the borrower wants. We all understand that the borrower wants the absolute least interest rate, and any investor, any lender will attempt to accommodate that. 100% loans don't exist except for straw borrowers, which we all know is illegal now. High loan-to-value loans exist, however, they must cash flow. The loan-to-value is almost immaterial. So if you're going to call an investor, you need to know what the building is cash flowing at and translate that into loan-to-value. In other words, Mr. Investor, can you do a 1.3 debt service loan at a 67% loan-to-value? That is the correct question, not what the highest LTV that you have is. Stated income loans are not really stated income. The appraisal is king. The appraiser will determine what the income of the property is and the value of the property. So you can state whatever you want, but the appraisal will validate it. Cash reserves are always required. If you have somebody that literally wants $1 million cash out or $500,000 cash out, and they've only got $3,000 in the bank, it's going to create an issue. You can't borrow cash flow. No-doc myths, no-doc loans are a myth. The appraisal is always king, and the appraiser will absolutely acquire all the documents that are needed to fund a loan. So the borrower may not provide them, but the appraiser will acquire them from market studies. Lastly, appraisal offers are not commitments until minimally the appraisal is done. Remember, we talked about when you have a term sheet, letter of interest, that's a commitment to move forward and conduct the third parties. If something happens during one of the third parties, you may not have a commitment. We've listed the 3 high points of why deals blow up, but the top one is property type and usage. If it's an exotic property type, you're going to have an issue finding a loan product. If you have unachievable borrower expectations, in other words, you have a borrower with very poor credit that wants no prepayment penalty and expects a lot of cash out, these sorts of things, that's unachievable. Understand you won't know that, but speak to your investors, speak to your underwriters, and find out if a borrower's expectation is even plausible and get an idea of how to proceed. If there's no benefit to the transaction, meaning that there's no cash out or the purchase can't be achieved with some cash reserves and the amount of cash required, there's no benefit to the transaction. Call it a day very early on. You'll want to specialize in a few product types. Small balance and construction loans are not a good blend. If you're going to be out after small balance loans, and be out after small balance loans. Don't try to be a generalist. If you want to go out after loans in California, small balance, multifamily, that's a great thing to go out and laser focus on. Even if you get a stated income loan, gather conditions for a fully documented loan every time. The more conditions you have, the more documentation you have, the better off you'll be. If a borrower tells you that he has not been shopping his loan and that his credit's excellent, that's great. We all trust everybody, but every loan has a story. If you're submitting a loan that doesn't have a story, chances are you don't really have an expectation that you can manage. There's no motivation. This is the tough part. You need to manage your consumer benefit and investor requirements equally. You can't be on one side of the fence or the other. No co-brokering loans. Work with the consumer directly, as we've spoken about a few times before, and become an expert, as we spoke to right at the beginning of this slide. Specialize in a few product types. Later on, as you gather experience, you could spread your wings. So, in closing, we really hope that you don't dabble. You either decide to market commercial loans or don't market commercial loans. If you dabble, you will get very, very frustrated, and this is what we're trying to avoid here. Don't dabble. Go out informed. Watch this video a few times, and then go start in on some of the processes that we talk about on our Facebook page and also our YouTube channels. If you're serious about the commercial loan business within any company, any investor, you can become an approved broker, you can become an affiliate. In all cases, there's probably significant restrictions. If you're in Florida and you want to market loans in California, you're going to get questioned about that. So talk to your BDM and talk to them about marketing opportunities. Talk to them about restrictions that might apply. So we hope you've enjoyed the video. There are more videos in the YouTube and Facebook channels that will address some of your concerns. And so thank you very much for listening.